Celsius is deeply insolvent, alleges Vermont Department of Financial Regulation. The troubled lender lacks the assets and liquidity to honor its obligations to investors, DFR said. Celsius Network, the troubled crypto lender, is deeply insolvent, alleged the U.S. state of Vermont's Department of Financial Regulation, noting the lender lacks the assets and liquidity to honor its obligations to account holders and other creditors. Celsius deployed customer assets in a variety of risky and illiquid investments, trading, and lending activities, the DFR said in a statement. Celsius compounded these risks by using customer assets as collateral for additional borrowing to pursue leveraged investment strategies, the statement added. That's pretty bad. Celsius is one of the crypto lenders facing financial troubles in the latest liquidity crisis in crypto. It suspended withdrawals starting June 12th, cut jobs, and hired restructuring experts to advise on its financial situation. Earlier on Tuesday, the lender said that it fully paid off its debt on the decentralized finance protocol Aave, freeing up $26 million in tokens as part of its latest debt restructuring maneuver. It also moved $418 million in staked Ether, or ST ETH, to an unknown wallet. Wonder why. Last week, CoinDesk reported that Celsius fully paid off the closed its loan on Maker, one of the largest DeFi lending protocols, and freed up $440 million of collateral pledged against the loan, denominated in wrapped Bitcoin tokens. Additionally, on Tuesday, the crypto lender reduced its debt by $95 million on Aave and freed up 410,000 ST ETH tokens worth $426 million at the time of publishing. It is good that that is getting released from the perspective of DeFi and hopefully avoiding DeFi contagion. And that's because, like we've talked about, the problem with the ST ETH is that it's backed by something that you can't actually pull out and back the actual token with, unfortunately. So kind of getting rid of that and freeing those tokens up is going to be extremely important. The DFR believes that Celsius has been engaged in unregistered securities by offering cryptocurrency interest accounts to retail investors. Celsius also lacks a money transmitter license, DFR alleges, noting that it means Celsius was operating largely without regulatory oversight until recently. Furthermore, the lender also failed to register its interest accounts as securities, leading to a lack of risk disclosures to depositors and other creditors. Due to the culmination of concerns about Celsius, DFR has joined a multi-state investigation of the lender, according to the statement. And California is looking into it now. So California is investigating multiple crypto lending companies. The state's Department of Financial Protection and Innovation is looking at whether firms that have suspended customer withdrawals and transfers have violated its law. The California Department of Financial Protection and Innovation, DFPI, is investigating several U.S.-based crypto lenders after a series of prominent lenders indefinitely halted withdrawals and transfers between user accounts, according to a press release issued on Tuesday. That will include Celsius, of course. The department didn't name the companies under investigation, but did say it is eyeing multiple companies that offer customers interest-bearing crypto asset accounts, Celsius, or crypto interest accounts, and service providers that may not have adequately disclosed risk customers face when they deposit crypto assets onto the lender's platform. Over the past few months, several prominent crypto lenders have frozen withdrawals and transfers as they contend with liquidity crises spurred by a dramatic market downturn that has caused crypto prices to plunge to their lowest levels since December of 2020, with Bitcoin below $20,000 several times in June. In mid-June, Celsius announced it would pause all withdrawals and transfers between user accounts, citing extreme market conditions. Then, in July, fellow U.S.-based lender Voyager Digital announced it would temporarily pause customer trading deposits and withdrawals. It then filed for a Chapter 11 bankruptcy just days after the announcement. The California investigation also comes on the heels of public comments from top regulators and politicians warning consumers about the risks of crypto lending. Senator Elizabeth Warren issued an email statement in June warning crypto lending platforms' claims of double-digit rates were often too good to be true. Too many crypto firms have been able to scam customers with too good to be true claims about safe sky high returns, leaving ordinary investors holding the bag while the insiders make off with their money, Warren wrote. I don't think they're actually making off with any money, by the way. I mean, they're claiming bankruptcy, and I think a lot of them are going under. So I don't think they're actually making off with any money. Just saying. The California DFPI has pursued investigations and taken actions against several crypto companies, including BlockFi and Voyager Digital, in recent months. The department found that certain crypto interest accounts from those platforms constituted unregistered securities. Securities registration is essential for ensuring that investors receive adequate information so they can make decisions regarding riskier than average investment opportunities, such as crypto interest accounts arrangements, the department said. I mean, it's really this basic, though, for people that are participating in crypto, which is not your keys, not your crypto. If you don't have control of your keys, then it's probably too good to be true in most cases, especially if it's like an interest-bearing account. And so even then, though, keep this in mind, DeFi in general is going to have its own risks as well. The only difference is that you can pull out, right, when it goes wrong. In addition to that, usually you will see much lower interest return rates on DeFi where you participate in it in a manner in which you control the keys, right? Your Uniswaps and so on. There are certain areas where it gets a little muddy even within DeFi though, like liquidity pools that do automated liquidity, where essentially whenever somebody buys some of it, it takes a certain percentage of it and burns it or puts a portion of it into a liquidity contract. Some of that stuff is basically just playing with and manipulating the currency to drive the price up, and you need to be extremely careful when you're looking at those projects. Thanks for checking out this clip from the Crypto Mining Show. You can check out the full episode here or more crypto content down here. Also, I'd like you to check out my locals page at sonofatech.locals.com where you can become a member for free or choose to be a $5 a month supporter that unlocks additional content.